Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Hi, good morning. Hope everyone had a pleasant weekend. We had the last weekend of November, Thanksgiving, which hope everyone enjoyed that. Had one of our own Ira Cohn marching in the parade. Here we are, December 2nd, first week of December, officially moving into to year-end. Our Herald and Lanton holiday party begins next week, December 9th, management meeting December 9th. So looking forward to whoever can join us on the 9th at the Harmony Club in New York. And going to get started this morning, December 9th. Some of the same themes that have been pervasive the last few weeks remain. Number one, IRA distributions. Remember to take your IRA distributions as we approach year-end. Big penalty if you don't take them by December 31st if you're over 70 and a half, and have to take that RMD. Number two, year-end tax planning. Keep in mind, take a look at your year-to-date realized gains and losses. Keep in mind, if you own mutual funds, you very well may incur additional potential gains in mutual funds that may declare capital gains as we go into year-end. Critical time to focus on tax mitigation strategies, whether or not you should be looking at any losses that you may have. You want to address those earlier rather than later, as others possibly hold similar securities to yours, and the selling pressure could get more significant as the month goes on. This is especially true in less liquid markets, like bonds. If you have bonds that have declined in value for whatever the situation may be that's unique to that situation, you want to get out ahead of that and take advantage of being able to reduce your taxes. And start thinking about what you want your portfolio to look like going into 2020. Perhaps 2019 has been a better year in terms of performance in equities than you anticipated. And you may think of rebalancing your portfolio, and again, thinking of what others may do come January 2nd, 3rd, or 4th. There may be some pressure to rebalance portfolios. Perhaps you want to think about rebalancing your portfolio earlier so that you're not caught up in that wave. So as we approach year-end, and lots of us start thinking about what we want to accomplish in the next decade, 2020, we set up our goals. Lots of times those goals are lofty, and what research has demonstrated is that sometimes when we set goals that are very hard to reach, that we give up on them more quickly. So I'm going to talk this morning about a recent study that shows how small habits can lead to big changes, and that making changes in our well-being and performance is often accomplished by making micro steps in our behavior. Small, actionable, science-backed steps you can take to make immediate changes in your life. There's nothing wrong with aiming big, but we can help ourselves by starting small. So some thoughts on how to get that done. Some simple, small steps. Number one, pick a time at night when you turn off your devices and gently escort them out of your bedroom. Our phones are repositories of everything we need to put away to allow us to sleep. Lots of stress often associated with information that may be on that device, to-do list, inboxes, projects, all potentially attached, even potentially subconsciously creeping into our sleep process. In order to get mentally prepared for bed, set an alarm 30 minutes before bedtime so that you can start the mental preparation and getting ready to truly be able to unwind. During the day, if you have a meeting with one or two people, instead of sitting in a conference room, try walking during a meeting. Take a stroll, possibly outside. You'll be less likely to peek at those devices we just discussed, and the movement can help the creative problem-solving juices. Can help get you creative and get the problem-solving juices flowing, and can possibly also get some health benefits from that movement. Block time on your calendar to manage your email. Do not sit all day and respond to email as it comes in like a hockey goalie. Another one. Studies show that it takes us an average of 25 minutes to refocus after being interrupted. So if we're consistently focused on getting back to that email and being interrupted, it's going to be very hard for us to accomplish what our goals are for the day. And finally, at the end of the day, declare an end to the day, even if you haven't completed your to-do list. Effectively prioritizing means being comfortable with your incompletions. More important than finishing every single item on your to-do list for the day is taking time to recharge and being ready the next day to seize the opportunities that you have unfolding in front of you. Okay, taking a look at the financial markets. So I'm going to talk a little bit about last week. We'll talk some more, a couple of good ideas, I think, from Barron's in terms of some income-producing stocks and closed-end funds, and talk a little bit about college planning. Then turn things over to Brad to discuss the bond market this morning. Taking a look at financial markets this morning. Where we are is we are up significantly from where we were at the beginning of the year. We had another good week last week, despite some red on the screen on Friday, which was the holiday shortened day after Thanksgiving. Friday we had some concerns regarding the U.S.-China trade deal, specifically President Trump signing the U.S. declaration of concern regarding the situation in Hong Kong, and the concern that the U.S. position might jeopardize the trade talks. Chinese had some strong words with respect to the U.S. position, but nothing has subsequently happened beyond those two declarations. We'll see if there's more to come. But this morning, after that sell-off on Friday, we're seeing a little green on the screen. But just going back to last week, despite that Friday news, S&P was up over 1%. The Dow was up about 0.75%. Nasdaq was up 1.75%. Foreign developed markets were up 0.5%. Emerging markets were down 0.8%. Put it all in context. Nasdaq's up almost 32% year to date. S&P 27, Dow 23. International developed markets 19, and emerging markets are up just over 10.5%. Taking a look at treasuries, the 10-year treasury bond is up about 13% year to date, factoring in capital appreciation and dividends. So a very strong year, not just in the stock market, but the bond markets as well. This morning we are seeing some weakness in the bond market. We're seeing treasuries off pretty sharply this morning, but still yields remaining low by historical standards. We're seeing the 30-year yield up to 227 from 220. That's 7 basis points higher. The 10-year is up 5 basis points. The 5-year is up 4 basis points. So weakness across the curve, and that's largely attributed to some stronger economic numbers coming out of both Asia and Europe. In China, we had a manufacturing PMI for November returning into expansion territory, better numbers than expected, 50.2, beating expectations of 49.3. In Europe, we saw a PMI come in pretty much across the board. We saw Germany's PMI come in higher than expected, the UK higher than expected, France higher than expected, Italy higher than expected, Spain higher than expected. The only outlier was Switzerland, which came in slightly weaker than expected. But all that giving a lift to bond markets, both in Europe and the U.S. in terms of yield, sell-off in terms of price. We had S&P raising Ireland's rating to AA- from A+. which again, significant. Good to put that into historical context. You go back to 2011, and there were lots of concerns that Ireland wouldn't even be able to pay their debt, and here we are 8 years later, which in the grand scheme of things isn't all that long, and we're looking at Ireland at AA minus rating from S&P. So taking a look this morning, the foreign markets, I mentioned some of those numbers. We're seeing the Hang Seng up about 0.3%, the Nikkei up about 1%, the Shanghai up slightly, and European markets are off just slightly this morning after those numbers. We are seeing those higher yields. We're seeing oil up over $1 a barrel this morning to 56.28 for Brent crude. About a 2% rise. We're seeing natural gas up about 2% as well. Gold this morning is down about $7. Gold right now is about $14.65 an ounce. In news today is what's called Cyber Monday. Cyber Monday has kind of morphed into a Cyber Weekend, post-Thanksgiving weekend. You know, and that's part of reflection of some of the changing technology. Cyber Monday used to be that people would get to work where they had their high-speed connection. After a Thanksgiving weekend at home, they had slower connections, and they would possibly spend some of their work time shopping online with super high-speed connectivity not just available at the office anymore. Cyber Monday has become a Cyber Weekend, and expected to see record numbers from online shopping this holiday season as well as this weekend there. Taking a look at the numbers that we have coming out this week, today we get the ISM Manufacturing Index. That's expected to be at 49.4 here in the U.S. Discussed that some of the PMI numbers came in strong overseas. We'll see if that carries over here in the U.S. Wednesday we get the ISM Non-Manufacturing Index. Non-manufacturing even more important here because service is such a big portion of the economy. That's expected to come in at 54.8, up from 54.7. And then the biggest numbers of the week come out on Friday. We get non-farm payrolls. Those are expected to rise by 182,000, up from 128,000. Average hourly earnings expected to be up 0.3%. The unemployment rate is expected to hold at 36.6. And the average work week is expected to be 34.4 hours. So talking about Barron's financial markets, mentioned a couple of weeks ago, maybe last week, Barron's getting a little more cautious. Barron's remaining cautious but not pessimistic is the way I would express it. Barron's discussing last week we saw the Russell 2000 finally break out to a 52-week high. Important to note that the Russell has been the lagging index of the small cap stocks, and while it did set a 52-week high, it still is 6.7% short of its peak, which was reached in August of 2018. The Russell's advance year to date is 20%, which is short of the S&P 500's 27% advance. The good news for the Russell 2000 is that December is the best month for small cap stocks. In the past 32 Decembers, the Russell 2000 has gained 81% of the time, averaging 2.59%. Part of that is due to the fact that the January effect, which is when people buy the poorer performing small cap stocks, usually they do it in January. People getting ahead of that and now doing it in December. And that's attributed to some of the strength we're seeing in the Russell 2000. Barron's also lead story. Thought this was a very fascinating story. Put things in historical context. Talks about some of the tech pioneers have been left behind. They say their stocks are cheap but complicated. They're not necessarily advocating for those stocks or disadvocating, but just putting things in historical context. And the article went back through the last several decades and looked at the top technology stocks by market capitalization. It's interesting if you go back to 1980, which is about 40 years ago. If you look at the top 10, there's only one company, and it happened to be number 10 in the top 10 in 1980, still in the top 10 today, and that company is Intel. The other 9 companies are not in the not in the top 10 at all, and some of them are in fact out of business. In the top 10, you have IBM, you have Eastman Kodak, bankrupt, Xerox, shell of its former self, Hewlett-Packard, which is in discussions now to possibly merge with Xerox, although it's hostile. You have Emerson Electronics, Texas Instruments, Motorola, and Nortel, another company that declared bankruptcy. Then you go to 1990, look at the top 10 stocks, and it's fascinating. IBM's still number 1 on the list in 1990, and then it's a slew of Japanese companies in the top 10 technology companies: Panasonic, Toshiba, NEC, Fujitsu, Mitsubishi, Sanyo, and Fuji, all in the top 10, and the other 2 companies outside of those Japanese companies, which are no longer in the top 10, are Eastman Kodak and Hewlett-Packard. So you go to 1990, and of that list, none of those companies are in the top 10 anymore. Again, demonstrating the ever-changing pace of how quickly things change in technology. You go to 2000, you see some familiar names. You see Microsoft, Cisco, Intel, Lucent, no longer around. Nokia, no longer a force in the technology business. IBM, Oracle, Nortel, and Sun. Nortel and Sun both no longer around either. And then let's take a look at the current stocks and keep in mind how fast things change when you think about these companies and your investments in technology. So today we've got Apple, Microsoft, Alphabet, Amazon, Facebook, Alibaba, Tencent, Samsung, Taiwan, and still number 10, as it was in 1980, Intel. Just a reminder of how quickly things change and how important it is to be flexible and nimble, and why financial advice is something that is valuable, and that you can frequently benefit from a second or third party opinion. A couple of dividend paying stocks to think about from Barron's, one of which is a stock that is a retailer, mall stock. Perhaps you've visited over the last week or so with the holiday season, and that is Tanger Factory Outlets. The symbol for Tanger is Sam King Tango. Tanger is one of the nation's largest landlords. They have 39 malls, 20 states, and even as the so-called retail apocalypse has laid waste to much of America's brick-and-mortar landscape, Tanger has been able to survive, and this article suggests perhaps even thrive going forward. The stock has not been immune to industry trends, though, specifically with regard to its stock price. The stock is down more than 60% since the middle of 2016, and that meltdown has led to the dividend yield rising now north of 9%. Stock was at $15.22 at the close on Friday. The company traded for less than 7 times funds from operations. That compares with some of their competitors, which are trading at north of 15 times FFO, or funds from operations. But Tanger's valuation, Barron suggests, seems especially cheap for a REIT that isn't in financial distress, has a 96% occupancy rate, and boasts high-end tenants such as Ralph Lauren, Brooks Brothers, Coach, or Tapestry, another word for it. Now, Tanger has experienced some distress as a result of the ongoing shifting in the retail landscape. There have been bankruptcies of some of their tenants, like Dressbarn, Ann Taylor, and Loft, struggling. But nevertheless, Barron suggesting, despite those concerns, they think that the stock could trade up to $20 a share over the next 18 months, giving investors a total return of about 40% in their estimation. They go on to take a look at their debt. They have about $1.8 billion in long-term debt, and they have about $15 million in quarterly interest payments due. The interest payments are covered more than 4 times by cash flows, and they have no debt maturing until 2023. Article also points out that Tanger's occupancy rate hasn't fallen below 95% in 38 years, despite all those bankruptcies that we just talked about. CEO just in a call the other day saying that traffic is up, and saying that he feels they're well positioned He says in good times people want a bargain, and in bad times they need one. In terms of the dividend safety, the article says Tanger's 35.5% a share quarterly dividend appears safe. The REIT has generated 52 to 64 cents of funds from operations over the past 4 quarters. Another dividend-paying stock Barron spoke favorably of, and this is in a different industry, but an industry perhaps even more out of favor than retail, if that's possible, and that is energy. Barron's writing up Suncor Energy, symbol SU. It is Canada's largest integrated energy company. They suggest it's a good alternative to Saudi Aramco, which is a state-owned behemoth that is going public in Saudi Arabia. Saudi Arabia actually said that the subscription is oversubscribed for Aramco. And there are some similarities between Aramco and Suncor. They both have very long lives, low production costs, and an ample dividend. But Suncor has a reputation for being shareholder-friendly. Morgan Stanley analyst quoted in the article saying Suncor is a poster child for capital discipline, returning cash to shareholders, and that analyst has, Morgan Stanley analyst has a $38 target. The stock is now around 31 and trading around 13 times projected 2019 earnings. The stock is yielding about 4%. The company is expected to increase its dividend at a rate of about 10% a year in the coming years, and it has been buying back 3 to 4% of its stock per year. Suncor produces 800,000 barrels of oil a day, 85% coming from tar sands. They have a lucrative refining business, best industry margins in refining in North America. Their margins are about double their U.S. peers, Valero and Phillips 66. In addition, Suncor controls a network of gas stations, petro stations in Canada. They have roughly a 20% market share. So you take the refining business and the gas station business, put them together, they generate about 50% of the company's profitability. An analyst at Bank of Montreal said Suncor is mispriced. It should be viewed as an income stock, and investors are attributing too high a risk premium to the income stream. That analyst has a $44 target on the stock. One of the beauties of Suncor is they have to spend very little of their capital to find new oil. They have about a century of oil sands reserves. That's on par with Aramco. And analysts that are favorable on the stock said that the company really runs more of a manufacturing business, taking that tar sand oil out of the ground, rather than an exploration and production business. So their exploration and production costs are largely just production costs, because the exploration risks, according to analysts, are close to zero, as they have such long lifetime reserves there. They've also been focused on bringing down expenses. In 2008, it cost them $36 per barrel to produce a barrel of oil. They've got that down to $20 a barrel today, and their break-even goal is getting that down to $15 a barrel in the next couple of years. Moving on, Barron's also mentioned a few closed-end funds that I think are worth mentioning. Barron speaking favorably about closed ends, especially in this environment where the Fed has suggested that they're on hold, meaning that short-term rates aren't likely to rise in the near term, but that is certainly a risk for closed-end funds that often use leverage. But given that if your thesis is that these short-term rates will remain low and the Fed won't be raising rates soon, then closed-end funds may make some additional sense, especially in a market that's starved for yield. In an interview, they spoke with an analyst who suggests taking a look at municipal closed-end funds, and he listed some of his favorites, one of which is the Eaton Vance Muni Bond Fund. The symbol is Echo Ida Mary. Trades at a discount of 7.8%. Tax equivalent yield, not the yield, but the tax equivalent yield quoted in the article, 6.8%. Also, EVN, another closed-end mentioned, 6.5% discount, 7.5% tax equivalent yield. Nuveen Quality Municipal Income Fund, symbol Nancy Apple Delta, 9.3% discount, 7.5% after-tax yield. And the Van Eck Vectors Municipal Income Fund, symbol X-Ray Mary Paul Tango, which buys shares of other closed-end muni funds trading at a big discount. The thesis here from the analyst is, he says, I don't know any other prognosticators who think the market will earn 7% next year. That's the after-tax return on a lot of these. If you want to be in bonds for ballast, he says the Fed, he expects to be on hold. He expects to be in a non-inflationary environment, and therefore he thinks the risk-reward in this space is good. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.